Good afternoon, everyone, and welcome to the Pinnacle Institute's Investing Portfolio. I'm Bill Nelson, the portfolio specialist for Pinnacle and one of our instructors for stocks, futures, Forex, and our Keystone program, the Pinnacle Method. Hope everyone is doing well today. Nice to be with you, and plenty of things I'd like to cover in our time together this afternoon. First, coming up, I want to make everyone aware of our workshops to help you understand more about the Pinnacle Method and what we're about in terms of helping your understanding of how the financial markets really work and how the Pinnacle Institute can help you take control of your own trading and investing. So, if you're new to trading and investing, I recommend you tune into the introductory workshops that you see there on the left. One coming up tomorrow at noon Eastern, and then again a couple of times next week, Tuesday and Thursday, at times that we hope meet your needs and schedule. And then if you already have had an exposure to our supply and demand or supply and demand strategy in general, and you've extensively studied it, tune in again tomorrow at 10 a.m. and Wednesday and Thursday of next week, where we have our advanced workshops for folks that have already had an exposure to the concepts, and we can help you take your trading and investing to the next level. So hope that works for everyone. It would be great to have you. So with that, let's get going. I'm excited. So some disclosures, obviously any of the ideas and things that we talk about today in terms of specific stock ideas, they are simply that. And all of you participating today understand that all trading comes with risk, and you acknowledge that any of the topics that we cover today do not come with any guarantee of success. And of course that we make zero money making claims and of that sort. And once again, remember that all trading involves risk, including any and all loss of capital. So make sure anything that we discuss today would meet your individual investing and trading objectives before moving forward. And then all of the material we present today is in fact copyrighted. And then of course, any endorsements, testimonials, or anything that may come up in our presentation or even that appear in the chat needs to be independently verified, okay? So with that, I want to cover a couple of things. So the key component of everything we do here at Pinnacle is based on the concept that buying and selling in the financial markets should be no different than buying or selling anything else we do in life. And yet, many people do the opposite when it comes to stocks and investing. And in this case, the financial news media doesn't help when they give their recommendations. They simply push their idea without any reference, typically without any reference that the current price of the stock is at an all-time high. So here's an example from Barron's that I picked up just this week from over the weekend. Great story on Progressive, gave out their rationale for why Progressive might be in your portfolio. But it says, the headline, buy Progressive. It's a growth company in a slow growth industry, meaning the insurance business. And then we can look at this slide directly from TradeStation in just a second, but this is the price. When this article came out, Progressive was maybe here at $100 a share. Many of us reading this story might go ahead and buy Progressive right here at its all-time high. What we do here at Pinnacle is, I'll say this again a little bit later on, but what we do here at Pinnacle is identify quality companies, upon which Progressive might be one. But we apply some parameters to that. But then we also look to buy these kinds of companies and these kinds of stocks on sale at a discount. And there are ways that we teach our members how to identify these opportunities. And we can show you a few of those even today. So, but the question is, I want to ask everyone who's listening today, what other business model can succeed if its core strategy is to pay a high price for something and then hope you can sell it even higher to your customers, right? I mean, it literally makes no sense. And so what we do is much, much different. We approach the markets with the understanding that there are great movers of price, which in fact are the institutions. And when they make their trades, they leave behind footprints on the stock chart. And then when price returns, we should see a reaction. These areas are unique and have characteristics, of course, that we spend a lot of time with our members pointing out. Let's look at some others, some stocks that we know about. Tesla. And this may be a little bit hard to see on your screen, but I just want to point out the differences between a green candle and a red candle. A green candle means that price went up, opened here at the bottom, and closed higher. A red candle means simply it closed at the higher point and then closed lower during this time period. This is a daily chart of Tesla. And we can see even at above $800 a share, lots of people were still buying Tesla, pushing the price up to $900. Imagine now you were the individual shareholder who, because previously Tesla was maybe a $3,000 stock, and you bought at $900, thinking it was going, from this point, going to continue back up to $3,000 a share. It very well could, but from the time that you bought it to now $700, you've lost almost a quarter of your investment. So the idea is, and we can look at Tesla, but the idea is to use the charts, find a company that you're interested in investing in or trading, and looking at the chart to determine areas of a discount. Okay, that is simply all we're about here at Pinnacle, and we go through the methodology on how to do that. Amazon, very similar, a little bit of an easier chart to take a look. People are buying Amazon here at $3,500 a share. Certainly got in at $3,270, and all that buying pressure pushed it up to $3,500. And again, at all-time highs. Beyond Meat. Many of you may remember this was a darling of Wall Street when its IPO, initial public offering, was announced just a couple of years ago. And obviously it's, their core business is selling products that have a look and texture of meat, but they're plant-based. And when it went public here at about this area, it's hard to see on the chart, at about $40 a share, had a dramatic, really nice opening few weeks, and price, within a month or two got as high as $240 a share. People were buying Beyond Meat, getting in at $200 a share, pushing it up even higher. These weren't necessarily the people who got in at $40, obviously. And then look what happened. Just maybe 6-7 months later, it's back down to very, very near its initial public offering on Beyond Meat. And then same thing, it's hovered between that $40 and $200. And now it's resting comfortably, almost smack dab in between at $121 a share. So just a couple of examples on the mistakes that many investors make in terms of wanting to get in on something without any reference about where did price come from to get there and where is it likely to go. So what are some of the things that we can look to that tell us with a greater degree of confidence than just taking a tablet of hopium and hoping for price to go up? And that is the role of institutions in the stock market. and even in the futures market, and also in the spot forex market as well. And that is the fact that let's just look at Coca-Cola here as an example. And the fact that there is a huge institutional ownership of Coca-Cola. And you can find this online at any one of the stock reference websites. And you can go to that, look at either the general profile, and then look at holdings. And then you can see who are the largest shareholders of any stock or even ETF that you might be interested in. And I want to draw your attention. Let's just look at Warren Buffett and Berkshire Hathaway. And the fact that over time, and I say over time, because there is no way Berkshire Hathaway could collect their 400 million shares of Coca-Cola at one time. So they began their accumulation, and it might be in 50 million share increments. I don't know. He probably reports that in some kind of quarterly, especially if he's taking a huge ownership of Coke, he has to report that to the SEC. That being beside the case, when any of these institutions are making their purchase, and if it's in a sizable amount, we will see price move up pretty dramatically from a given price point. And the idea is that these 400 million shares cannot be all filled at one time. So when price comes back to the desired area that Warren Buffett, Vanguard, BlackRock have decided where they think that picking up shares of Coke at a discount works for them, that's where more and more of their accumulation of shares will occur. And we can spot those on the price chart. The same thing for General Motors. Any company that is publicly traded, and certainly any company that we know about, will have some kind of institutional following. And with that, we can look a little bit deeper. The same thing. Some of the same suspects show up from time and time again on any of the big companies that we might be looking at. And BlackRock here is the largest institutional shareholder of General Motors. They own 106 million shares. I don't know this, but they might even be in some kind of dividend reinvestment program, which is why we see some odd lots. But in either case, they are a 7.4% owner of all the shares outstanding of General Motors. And then comes BlackRock. And the same goes true. So all of these significant holdings of this publicly held company, General Motors, occurs in batches. And when they are finished accumulating, then conceivably they will start selling some of those shares at points high up on the market. And again, we use the charts to tell us where these institutions are beginning to unload their holdings, because they leave footprints on the price chart after doing so. Okay. So before we go any further, I just want to share with you about the Pinnacle Portfolio. You find this as a member. We post all of our open positions, our pending positions, and any stock that is reported in terms of on our pending list that meets entry and either hits target or just becomes an open position where we're collecting dividends and making some stock option positions against it. All of it is reported here on the investor program and the portfolio set of tabs. So there's the open tab, pending, and then our performance. So whether we hit target or we get stopped out, all of our positions are listed here for you. And then we also do options, which we're going to talk about in just a second. So our approach to investing is really incredibly simple. And it really involves identifying quality companies at a discount, which we quality companies, and then looking to buy them at a discount. No different than Warren Buffett or the management of BlackRock wanting to buy shares of Coca-Cola, but determining in advance what they are willing or what we are willing to pay for those shares. And when you can buy something at a discount and it moves up, we obviously enjoy a much greater percentage of price appreciation and a rate of return versus buying something at an all-time high and hoping it's just going to go up from there. So our components to our strategy is simply this. We look to buy at a discount and therefore enjoy price appreciation. So we have a long bias. And that's a term we use in the investing field and trading field, where we buy something and we hope it will go up over time. And that's called being long a position. We also look to collect dividends along the way while we are holding our stocks. Okay. And then we use two very, very simple option strategies called covered calls and cash secured puts to help us with our rate of return while we're waiting for price to hit our desired entry point. We call them demand zones. We'll just do this really quickly here, and let me just review with you the two option strategies that we use. The first, it's termed a cash secured put. And what it is simply this. We are willing to own the stock, but our position is that we sell to open our stock position. And in exchange for that, we are the receivers of premium. The option, how much individually that option is worth. And so we sell to open, but when we do that, we then take on the obligation to buy the underlying stock if its price is at or below the strike price at expiration, which is why then we use our entry points, demand zones, as a way of selling to open our position, because when price comes back into that area, we were willing to own the underlying stock at that price anyway, and now we just got paid to buy the stock. And of course, the alternative is just having a limit order and receiving nothing other than getting your order activated and being in the position. So you can see how over time being paid to enter a stock position can, and when you add in price appreciation, can greatly add to your rate of return. So this is where it's a key component of what we do here at the portfolio. The premiums we receive offset some of the risk of the price going through the demand zone. That's what DZ stands for, or our willing to own zone. Obviously, should price never reach demand, we get to keep our premium. And the full value, here's the thing about cash secured puts. The full value, especially in an IRA, a retirement account that you may have, the full value of owning each 100 share contract is set aside by your broker. It's almost as if they treat it as if you bought the stock at the time that you sold to open your position. Now, the one thing to keep in mind if you're new to options is that an option contract involves, each option contract involves 100 shares. So you got to keep that in mind. So the full cost of, let's see, if the SPY is at $400 a share, so that would be $40,000 that you would have to, that your broker would set aside on your behalf. Okay. And then once we're in a position and we already own the stock, we sell to open to receive premium, but we're already in the position. So what happens is once we sell to open our covered call, we then take on the obligation to sell the underlying stock if its price is at or above the strike price at expiration. So when we look at selling covered calls, we look at an area on the price chart where we might want to exit the position anyway. And if that's the case, that is where the market will pay us a little something extra or a lot extra for leaving our position, exiting our position. And it is a little bit of a bonus. Now imagine that should price not reach the supply or strike price, we can keep selling covered calls until the target is reached. The premiums that we receive offset some of the risk of price decline while owning the shares. And of course, adding to our rates of return if the stock goes up in price and is at or above the target at expiration. Okay. So that is the thumbnail on, the Pinnacle portfolio and our investing strategy. So now let's look at it and how we approach and apply the strategy in very, very simple terms just by using the stock charts. Okay. Oops. I do want to share this. So along the way, we track our all of our option positions that we recommend to our members on a monthly basis. And primarily we use the monthly expirations in the investing area. On the indexes and some very highly liquid stocks, you can trade them on a weekly basis. We pretty much stick to a monthly expiration, and you can see over time how how we're doing. These are gross amounts that are reported. If you buy to close a little bit earlier, then the actual net could be a little bit less than that. But the benefit of buying to close your cash secured put early means you get to redeploy that capital. So we have some specific rules that we outline for our members on how to do that as well. And instead of waiting the full 30 days, if you can get out early, you might actually in a calendar year get a couple more bites at the apple in terms of return. So again, that's our approach to the option market and what we've been doing so far. So let's do a couple of things. Let's actually look at Progressive. And and very simply, this is the 240 minute chart off Progressive. And the kinds of things that, and again, this is just for demonstration purposes. You need to decide on your own whether Progressive meets your needs and even whether this chart makes sense to you. And if you don't know what you're doing, just don't know anything about supply and demand, my recommendation is just follow along and attend our workshops where you'll get a much more detailed explanation of what this is about. But let's just say, and this is what I did over the weekend when I saw the article about Progressive, and if I was interested in looking at it, well, I asked myself, where would be a decent discount, and applying the methodology that we use here at the Pinnacle Method to identify a quality entry point. So even on a $100 stock, getting in at about $90 a share and hopefully seeing a return back up to over 100, and even if it makes it back up to 105, that would just, this move alone would be a 15% return versus getting in here and really needing the stock to hit 120 to get that same return. Let's just say if we got in here at the $90 level, let's actually take a look at what the option market might pay us. And we will do that just real quick. In terms of a covered call. Just slide that over. And let's just say if we got in and we'd be looking at selling the 105, covered call, and we got in here at 90, we'd be making an extra $275. $275. And remember, the option pricing is when you see this on the price list, and this is just a price list. I know for anyone pulling up the option chain, it can be so incredibly confusing. There's lots of things on here, but really, in essence, we look at the strike price. This is what triggers the option position. And so no matter what platform you use, the strikes are down the middle. Something called puts, and we talked about a cash secured put is on one side and the calls are on the other. And we sell to open. So on the sell to open side, it's the ask. And so right now, if we were, it's the bid. So if we are already in progressive at $90 a share, we could sell a covered call at 105 at 275. Okay. So that's a little bit on how a covered call can work to greatly add, or not greatly, but to add to your rates of return, in addition to this 15% price appreciation. And at $2.75 a share, that can bump up your return up to 17%. And all you did nothing extra other than offer your shares at a point that you were willing to get out anyway, and be paid for doing so. Okay, so that is how that would work. Let's keep going. We'll look at a few of these. And like I said, these were a few recommendations that we made. And I want to make very clear, we report to our members an entry point and a suggested target. And if not a suggested target, then we're interested in just collecting dividends and then potentially move our stop up to protect our gains along the way. This is Marsh & McLennan Companies. This was an area of opportunity that we identified. Price had spent a fair amount of time above our zone, but by being prepared to take advantage of the opportunity, we got in at roughly 107. Price met our target of 119.73, or about $120 a share, and price has continued. Let's do a few more. McDonald's. This was our zone that we identified earlier over the summer of 2020. Price came down into our demand zone and then hit our target, which was up here at about 207. And I don't mind sharing with you a few of our open positions that we have currently here in the portfolio, the Pinnacle portfolio. We identified an opportunity on IBM here at 106.08. Price met entry for us back in November. And as we saw right around the election, correct, we saw a little bit of a correction in the market. And that is an ideal time to be prepared to take advantage of opportunities. So here at Pinnacle, when we see price making some pretty significant legs downward, our approach is to make sure we are ready to capitalize on those opportunities. We also look at areas where prices drop from and look to see if those are not either shorting opportunities, which means we're selling to open our position and then we'll buy it back cheaper, or we can actually use cash secured puts, buy puts up here and enjoy the price decline as well. But anyway, that is IBM. Let's look at Unilever. Certainly, this was our zone that we previously identified. Had to wait a while for price to come in and meet entry for us, and now you can see price is back on its way. We'll look at Colgate. Similar, this was the opportunity that we identified using the Pinnacle method, and now saw a little bit of a reaction from an area at the kind of higher up on the price chart, and now we see price moving through it. And now let's look at Tesla, right? Our approach here on something like Tesla is simply to identify opportunities where we believe will be a turning point on We had earlier this month and towards the end of April, we recommended to our members, we saw this opportunity and recommended to our members that we should see a stop in terms of the upward trajectory on Tesla here at this location, and price is continuing to react from this area that we pointed out in advance to our members. So this is the kind of thing that we look for in both ways, looking to go long and those opportunities. And then we'll just look at one more, Johnson & Johnson. This was a situation where we didn't have to hold J&J for too long. This was the opportunity that we identified, and it hit our target pretty quickly. And then obviously J&J continued to do its thing along the way. So that is a very, very quick overview in terms of how we approach the charts and with the opportunities that the institutional investors. And so we can look at, let's go back and look at Tesla just real quick. This kind of a move down, this kind of a move with a gap down can only occur when there is a huge imbalance of more sellers than buyers here at this location on the price chart. And it's not just this area because there was a gap, but other components that we apply in terms of looking at the chart told us that there was a high probability of institutions beginning to unload their Tesla shares here at this location. Similarly, when we see something like this, the chart tells us where to begin looking for opportunities to go long on Tesla. And typically we look below areas, in terms of when price makes a sharp move downwards and stops. It tells us specifically where to look, and we apply our methodology and look for opportunities there as well. So, and again, it's where we see institutions leaving their footprint on the stock charts of their buying and selling of stocks, futures, and even in the Forex market. Okay, so with that, I want to wrap up my session thanking all of you for tuning in. So appreciate it. And just make a note of the fact that hopefully you're interested in learning more about what the Pinnacle method is all about, how it could help you understand the financial markets a little bit better, but more importantly, how they really, really work and the role of what the institutions do. And the fact that we would rather be on the same side of a trade where Warren Buffett and Berkshire Hathaway are buying shares of Coca-Cola versus having our orders to go to buy Coca-Cola at the very top of the market when they are looking to unload those shares. It's more or less being in front of a steamroller, right? So if that is of interest to you, we hope you'll tune in. So those are our introductory workshops beginning tomorrow, and then we take it up a notch in our advanced workshops as well. And there's one tomorrow at 10 a.m. Eastern, and then throughout the week next week. So hope to see you. Thank you so much for tuning in. It was my privilege to spend this time with you. And if you have any questions, do reach out to us here at the Pinnacle Institute. Thank you, everyone.